Welcome, everyone. I'm Angelo Robles to the Angelo Robles Podcast. I'm also the founder and CEO at Family Office Association. Tonight, we're hosting a very special session called Family Office and Professional Investor Shares How His Portfolio Has Adapted in 2020. It features Martin, known as Marty Gross, family office investor and founder and CIO at Sandalwood Securities. I've known Marty for a couple of years. He was introduced to me by a fellow family office a couple of years ago, and he has made an appearance on our podcast and our program before. That would be June of 2020. And for some context, if part of this does make it into YouTube or one of our podcasting platforms, were early mid-December in 2020. So it's really about 6 months later, and we're obviously much deeper into COVID. Like I told our audience privately, what I enjoy about Marty is he's been investing for a long, long time, both directly as a direct investor and allocating probably over the years to dozens, if not more, perhaps 100 more of managers. And really among all spectrums, he's not limited just to one area. And he keeps a very open mind to how things change. And we're going to get to some of that and some newer opportunities. And really, probably what many of you want to hear is, are there asymmetrical opportunities where there could be some significant upside? Now, give us a little while to get to that. So I got to keep you hanging a little bit with a hook. But why don't we start off with Marty? Welcome to the show.
Nice to be here.
It's great to have you here. Why don't we start a little bit broadly from kind of a macro perspective, or Angelo's perspective of a macro perspective? We're about 1 month in from the elections that have occurred. There still is some doubt, but let's make the assumption that likely it's going to be a Democratic presidency. We know what happened in the House. There still is an issue in Georgia that we're not going to know for a couple of more weeks, but that could be heavily impactful to investors. If you don't mind, let's get your opinion and explain why.
Sure. Georgia is an interesting state. It has a law which says that you must win 50% of the vote in order to win the Senate race. So based on the last numbers I saw, Purdue had about 49.7 or 49.8% of the vote. So he was 2 to 3 tenths away from winning the seat. Ossoff had around 47 something, and the Libertarian candidate had 2 point something. The Libertarian candidate got around 115,000 votes, more or less. Purdue needed 13,000 more votes out of 5 million votes, give or take, approximate, to win the Senate race. So because he did not hit 50%, that's why there's the runoff. The other one, where now it's Loeffler versus Warnock, I think they actually refer to that as a jungle primary, where there are as many people as possible that can run. There's no limit to the numbers. And so the top person there, I think, got 30%. So the two top people, which was Ossoff which was Warnock and Loeffler, are now fighting for the other seat. So why does it matter? President Biden, I'll say President-elect Biden, because I think that's what's going to happen, has published a very, very material tax plan, which could have put the marginal bracket for certain wealthy individuals in blue states into the 60+% bracket. So if that all happens, then number one, that will have a major effect on the demographics of the United States. Number two, significant tax increases may or will probably have a material effect on the economy. Depending upon who you ask, it's not clear whether an increase in the corporate tax from where it is to 28% has been baked into the markets. From the people that I'm speaking to, they think, and there's no way to know for sure, that a divided government scenario is baked into the market. If we have the Democrats controlling the House and the Senate, as well as the presidency, then that creates scenarios for more, shall we say, extreme results coming out of Washington, D.C. As a result of not having to work on a consensus basis. So Georgia is very important. It determines who controls the committees. It determines whether The Democrats, if they control the Senate, might want to add states. I only mention that because Senator Schumer has mentioned that. There's many policies there that will result in the spending of a lot more money and significantly different tax structures for the country if, in fact, it's 51-50 with Kamala Harris, Vice President Harris, breaking the tie. So Georgia matters a lot for markets. It matters a lot for the economy. Just based upon listening to what the Democrats have said they will do if they have the chance. When I talk about this, I do not mean to be partisan. I absolutely do not mean to be partisan. I'm simply looking at what I think the results will be for the economy and for the market if one scenario comes about as opposed to another.
And I know you're not a macroeconomist, but you are an investor. And tomorrow I have on Raoul Pal, who is, although not an economist, an iconic macro investor. But I'm going to ask you effectively some of the things so we can build up a little bit of our story here. The US dollar has been the dominant currency of the world for about 100 years. If you look at history from an economic perspective, that does change. Before that, it was the British pound. Before that, I forgot what the Spanish called it, but it was that. We're in a unique time now. We have a very high deficit. Countries are challenged for many reasons, but COVID certainly made it more challenging. We're in a tough spot here. I can make the argument for deflation or inflation. Here's what I'll say about inflation. We really haven't had it in a long, long time. We had it in the 40s and obviously in the 70s. And public equities reacted differently both times. In the 40s, it was a great year, great decade for the equity market. In the 70s, horrific. I mean, I remember growing up in New York in the 70s, it was terrible. We may get to New York and real estate and other things shortly. But talk a little bit about your opinion from where we're headed from either inflation or deflation, then we'll take the public equity conversation from there.
Yeah, well, I'm not a macroeconomist. I once went to a lecture where the person said, I have no background in economics, and that's an advantage I do not intend to give up. Okay.
Yes.
And I think it's clear that a lot of people have been wrong about inflation and deflation. So I just have a kind of a gut view, which really is two parts. Number one, it's very, very difficult to predict because the traditional parameters that people have been using to predict it haven't worked out as well. But as you were asking me the question, I actually thought of something that might be going on. One thing, and we can get there, one thing that COVID has done has to create a significant class of investments which have done very, very well, Zoom, whatever, and other investments that have done very, very poorly, like restaurants and cruise lines, right? Airlines and hotels and any business that requires people to congregate together. So as you were asking me the question, it occurred to me that it's not clear to me that deflation versus inflation is a binary circumstance. I can imagine, and we might be seeing it right now, where we're seeing very significant inflation in the price of equity securities. And most people will argue, especially on the growth side, that the valuations are historically very high. Other people, and they clearly point out the fact that the difference between growth and value is historic. So I could easily see why we're seeing inflation in terms of the increase in pricing of equity securities for many reasons. One is low interest rates don't give a good alternative to equities. And the second is an unbelievable amount of money that's been printed and has to go somewhere. So if that's where there's inflation, where's the deflation? Well, the deflation's in the price of oil, right? The deflation is how much does it cost you to rent a hotel room in Manhattan?
It's a hell of a lot less.
Yeah, it sure is. The deflation is office space and many others. Okay. So I kind of, as I look out there with a, shall we say, down to earth, more commonsensical view, based because I can't formulate my own macro models of deflation, inflation, it's pretty obvious that when you look at different sectors, you're seeing some where the prices keep going up and you see some where the prices keep going down. So to me, inflation versus deflation kind of requires more of a dive into which particular asset classes and which particular businesses. We're seeing both.
Completely agree. And if you look at some of the charts and statistics from some of the iconic macro thinkers and kind of compare with history, the 40s and 70s, and how they were so different from a public equity perspective, uh, we don't know. It's very concentrated. It's kind of the FANG plus Microsoft, a couple of others like Zoom. So the days of saying I have a basket of equities in the S&P 500, that probably did you pretty well, for the last 10 years until something like this. Then you have some winners and a hell of a lot of losers. So it's a time to maybe go from being strategic to being tactical. It's a time potentially where talented investors could finally, after a very much a down period for many of them in equities, have a chance to shine. Now, perhaps I could argue there's 5 or 10 big winners. Just pick your own basket, monitor it, and maybe from a public equity side, you're better off. But you've been a hedge fund and an allocator to equities for 40 plus years. Are you seeing that there could be a return to the tactical, to the alpha, to the managers that could get, above average returns?
Well, there always have been managers that have been able to get above average returns. They're a very small percentage of the hedge fund space. Some of them run trading operations. Some of them hedge at different times when they think it makes sense. Others always hedge. What is, I think, definitely happening, which is why active management might really have a chance to shine here compared to how it usually does.
It's been a long time.
Yes, is because there are a couple of things here. There are definitely securities that are pricing in certain recovery scenarios when it comes to COVID, and some of those opportunities and scenarios are very, very conservatively thought of right now. You have to pick them carefully, but and there's some serious damage in a lot of industries, which isn't just equity securities, but it's also real estate, and you can play that through securities. So I think the fact that we're finishing up going through, we don't know when it'll end, but we know that we see the light at the tunnel, but we don't know how far we are away from the light. There's been so much destruction in certain places due to the virus that there's a lot of opportunity there to parse through that and to see which companies' equities are valued, assuming we get rid of the virus in a month as opposed to a year, as opposed to 2 years. You began the talk with someone who was talking 2022. From what I'm hearing, that's a pretty conservative estimate, especially if it's true that the vaccine is 50% effective after you take the first shot. So there's definitely, whenever there's very, very significant distress, which we have now in some sectors, especially in some real estate sectors, it's a real chance for people to distinguish themselves from index funds.
And real estate is going to be a good part of what we'll talk about. It's coming up shortly. So we kind of spoke about that inflation. We don't really know. It's tricky what happens in the public equity markets. If you look back at history, I would say it could be good if you're going to be tactical, and some of the obvious winners are here now. But again, that could change, but that is going to be a part of your portfolio that could also hedge against inflation and could give you some wonderful returns. But if we're in a deflationary environment, it doesn't take a genius to know that that's very bad for the dollar and for treasuries and bonds. And we've been touching upon deflation for kind of a long time now, but the central banks, the Fed here in the US, have done everything they could, right or wrong. You could probably argue either point, to make sure that doesn't happen. So we talk about inflation like it appears like it's likely, and maybe it is, but we've been more on the cusp of deflation for a long, long time. Are you tactfully and tactically both really watching that carefully? Because when I did my surveys on institutional investors, and I know that's different than families, they have like a third effectively in cash and in government bonds, and bonds even broadly. And that's like, oh my God. I mean, they need to play it very safe. It's the nature of that community, especially if they're a pension fund. But if we hit deflation, and I think you can make a hell of an argument for it, at least partially, that's a terrible asset classes if you're not going to be tactical.
Look, we already have deflation. It depends where you look for it.
Yeah, good point.
We've listed where deflation exists. So we're going to be seeing both. When we think about being tactical in our allocation, our our family office has essentially a very institutional-like allocation. So why do I say that? If you compared our allocation and the buckets in our allocation, we're very similar to most universities and other groups. So what does that mean? So we have cash, we have equities, we have hedge funds, we have real estate through funds, we have real estate we own direct, we have private equity, most of it shorter term distressed private equity as opposed to 10-year private equity. We have venture capital, and we have lending funds. So that's essentially 8 buckets, where real estate is 2 buckets, one dealing with funds and one dealing with direct investments. We tend not to try to tweak the portfolio too much due to macro factors because it's just too tough. I remember 3 to 4 years ago, the hedge funds that were talking about, going short treasuries because they knew rates had to go up. Well, they've been wrong for 4 to 5 years. Okay, so it's very difficult to do the macro and get it right all the time, or most of the time. So when we think of, we have about 7-ish% in cash. So why do we have it? Well, you never know when you might need it. It's an option on opportunity. We have capital calls that we may have to use the cash to meet if we don't have other things generating the dollars to meet them. And then we have about 40% of the money in hedge funds. So we're talking about, about 60% of our money is in cash, equities, and hedge funds being 40%. So why do we use them? We use them because over time, number one, they tend to be much more credit oriented than equity oriented. So distressed oriented, things of that sort, structured credit. So if you ask me how much credit do I have, I view the cash as credit. It's basically daily credit. And the hedge funds also give us a lot of credit. We also invest in hedge funds to do activist equity. And then about 8 points of the 40 is in biotech. We've essentially created our own biotech allocation, and I'll get to that in a minute. Our real estate is basically broken into 2 categories. We use funds and we have direct investments. Overwhelmingly, the direct investments are in multifamily properties, as opposed to retail, as opposed to office, as opposed to others. So I'd say it's 90+% in multifamily. We're never going to make killings in multifamily. Okay, it's highly unlikely. Those deals tend to generate between 6 and 9% cash on cash return from day one. We try to have properties in good areas. We're not trying to go into inner cities and, just be rent collectors and not treat tenants poorly. Not that people in inner cities do that, but I'm just saying that we're not in the inner city game. We're mostly in the Southeast and garden apartments. So whether we have inflation or deflation, multifamily has been good. Okay, if we have inflation, it'll be good. If we have deflation, we don't think it'll affect us that much, other than with interest rates going down even more, we can still refinance. So we don't view this portfolio as one that is going to have within it tactical shifts. The other issue is whether we have inflation or deflation. The issue really isn't whether we have inflation or deflation. The issue is, do we have a lot of inflation or do we have a lot of deflation? Because if we have a little bit of inflation or a little bit of deflation, it's not going to make that much of a difference. Okay, it's really whether we start seeing extreme moves in either direction. So let me just get back to the biotech, because that is something that we're very, very keen on. We're increasing it. We could go up to 10% of our portfolio in biotech. And the reason is that we're extremely comfortable with the people we invest with in biotech. And we're just betting on scientific innovation. We think COVID is just going to make it even more interesting in the space. More and more smart people are coming into the space. The people that we interact with our biotech managers as well as their companies are people of very, very significant intellect. They've done very, very well. They're very smart. They're really on the cutting edge of science. So we could easily see ourselves, teetering on 10% of our portfolio in biotech. So how would we structure that allocation? Okay. At the moment, we have 3 different hedge funds that are in biotech. We have 5 different funds that are early stage biotech. Okay. 3 of the 5 are also run by the hedge fund. So it's the same people. And then we're in 5 or 6 one-off biotech companies that we decide to go invest in if we know one or two people in that space that we kind of follow their lead. So essentially, we do a little bit of one-offs. They might be at our total one-off portfolio might be 2% of all of our assets. Hedge funds could be 3 to 4, and the private equity in biotech could be 3 to 4. So we're very, very interested in that space. We don't think inflation or deflation makes that much of a difference there. When we structure a real estate portfolio, in addition to the directs, I said we also do funds. We have two kinds of funds. The first kind of fund is the general allocator, of firms we all know. Blackstone would be an example of an allocator that if you give them money, they could go to different states and different asset classes. So that's what I mean by a general allocator. And then we do about 2/3 of our book are with local operators. So we have one person that just does hotels. We have another person that just does multifamily. We have another person that just does, for example, mobile homes. And so we have a blend of allocators and local operators, mostly local operators in our book. Our lending allocation is very simple. We try to use lending funds for most of our non-taxable accounts, whether it's the pension, profit sharing, or foundation. And we're able to generate what we think are pretty good low double-digit numbers with real estate collateral, virtually only first mortgages, very, very minimal leverage. Okay. The other area where we're very active is in venture. That might be 6 or 7% of our assets, although it's growing because of the success we're having with some venture. I hope the success doesn't kind of get us addicted to something that we shouldn't get too addicted to. But when we think about putting a venture portfolio together, we have about 14 different funds. Some of those funds, I'd say the biggest fund might be a 1% allocation for us from a net worth perspective. Many of them are 30 to 40 basis point allocations. And the reason we're investing in that many funds with amounts of money that someone would say can't move the needle that much is because we want to get to know more and more general partners. We are seeing more and more sidecar deals from some of the smaller funds. We just want to get to know more and more people by actually being in their fund, living with them, seeing how they behave. And so we mix smaller funds with larger, more well-established funds. In terms of putting that allocation together, there's a number of considerations that are involved. The first is when we do a look through on the venture side, we want to end up being in tech companies, biotech companies, fintech companies, cyber companies, et cetera. So we want a broad range of the kinds of businesses that our allocation will touch. We also want to see a diversity among the level at which we do our investing. So we do have funds that will participate in seed. We do early, we do growth, we do pre-IPO. So the allocation touches all of the basic stages of venture. We want geographic diversity. What I mean by that is that the ecosystem in the US, we definitely participate in. We have funds in Europe, and we have a couple of funds in Israel that have been around for a very, very long time. They're kind of like 3 different venture ecosystems. We want to be in those different ecosystems. So that geographic diversity is something that we want to add to the mix. We want to have funds that have different magnitudes. So we will have, as I said earlier, larger, well-established funds and smaller, in some cases, first-time funds. We're an active participant in sidecars. So sidecar investing is something that definitely is viewed as something that will come off of our venture portfolio. And we believe that there are many young, intelligent, very entrepreneurial managers in this space that will become leaders, and we get a chance to see more of them. One thing we look at is, for example, if we're in a fund that does seed and A rounds, when we get to the B and C rounds of a given company, do we see the major venture funds participating at that point in these companies that the younger entrepreneur found, but the rounds were basically too small for the larger funds? So that's just a brief listing of the considerations that go into our putting a venture portfolio together.
Wow. And the number of funds you have an active investment in is significant. Like you said, they could be small positions, but it allows you to
Yeah.
get to know the fund and look at some
Right.
one-off and direct deals. I think that's a great idea. I'd like to correct myself. It is after 7 o'clock. I got up at 5:30 this morning. I've had a long day. Uh, and many of you being sharp investors would know the opposite of what I said about 10 minutes ago. In a deflationary environment, cash and government bonds could actually do well. It's the opposite. It's inflation.
Right.
But the challenge is we just don't know. It's
Right.
just so tricky. We were on the cusp of deflation, but there's some inflationary obvious things that could happen. And that's why you got to be so tactical in today's market. You can't just sit back. It's just not the time for. I have some families that do that. They're like, well, we're long-term investors decade after decade. And there's a point to be made for that. But if we do end up having higher inflation, if we do end up having the tax picture that starts to look ugly, and we have some families that withdraw above 5% of their assets every year, take a look, do the math. After 10, 15, 20 years, your net worth, even for the super wealthy, could be decimated. You really need to be careful. And this is not the time just to sit back and forget it. And there may also be some opportunities now. I have a couple of questions for you. You're very, very active investing in effectively managers. Part of the challenge that I've seen, and you're going to know this as well, that I've seen with hedge fund managers. I know some great macro managers that back in the day were getting, incredible returns. Now, we could argue they were smaller, trades were less crowded, there was less competition, there wasn't as much publicly available information. They had huge advantages that to some degree may not be there now. I'll give you that. But part of it became the institutions came in the 90s. They gave huge checks. These managers went from having hundreds of millions to even a billion to having 3, 5, 10, 15, 20 billion or more. Let's face it, the pensions wanted less volatility. They wanted the managers to be more careful, and effectively they became glorified asset gatherers. When do you make a decision to get in and out of a manager?
We have 5 hours.
No, let's give this one 2 or 3
yeah,
minutes.
No, sure. There's a couple things that have us do that. The first is if we go into a strategy and the strategy doesn't work, we made a decision, a bad mistake about the strategy. Okay, that tends not to be an issue for us because we're only in a few strategies that have been around for a very, very long time. Okay, so we don't usually make strategy mistakes because we're only in a few strategies and they're the plain vanilla ones of distressed credit, activist equity, things like that. One obvious case where you get out of a manager is if for whatever reason he underperforms or she underperforms his peer group. So if you have five managers in credit and one of them does very poorly compared to the others, that's obviously a red flag about rethinking why you're there. When you have a person retire and transfer the reins to a successor, okay, that obviously requires a very careful look as to whether you want to be with a successor. So I would say that to a large extent, it's not keeping up with the peer group for one reason or another. It's not usually the case. Sometimes a manager will get too big, okay, and they will manage to lower returns but high enough to keep the institutional capital. So in some case you have to be careful about that. On the other hand, we hear that size kills, and yet our two largest managers were basically flat in the first quarter of this year, okay, as well as one of the smaller long-short credit managers. So size requires a careful look to see whether in any given situation size creates a problem. But size is not necessarily a problem. It depends upon the overall strategy and how that portfolio is managed. So size is clearly a consideration, but it's not a clear action causer, to make up a word here. Okay, it gets down to comfort with the manager from the perspective of keeping up with the peer group. If you ever see style drift, you would get out of the manager. We rarely see that. Size can be an issue. If we see manager holding cash for too much cash for too long, they should just return the cash. We see that sometimes, not always. Especially now, as many hedge funds have been around for quite a while, there's a group of them that have been around for 10 to 20 years, and you're starting to see people retire or transitioning to family offices, but still keeping a small number of clients. That's something where we tend to be very comfortable with, as opposed to someone saying they're not paying any attention anymore. In the few instances where we've stayed with somebody after they turned into a family office for themselves, but kept some clients, they've done exceptionally well. And so those are the basic things that have tended in the past to have us move away from some managers.
And a part of it's going to depend on your opinion of inflation, of monetary policy, of the dollar. Back to equities for a second. Are you active at all, even if it's a tiny percentage, directly or with managers in emerging market equities?
We have some exposure to that. I used to, when I was on an investment committee and we debated emerging market managers, our conclusion was that we already know how to lose money here. We don't have to improve our skill set in other markets.
That has been a wickedly challenging market for many decades.
but the thing is this, because so many American companies are global companies, you do have global exposure, including emerging markets with some American companies. Generally speaking, as a firm, we have dabbled in emerging markets, but we have not made it a material piece of our allocation. We are perfectly happy to get emerging market exposure, both equity and credit, through our managers who will from time to time go to emerging markets.
I'll mention something now that is piping hot among substantial families. And I want to know from your perspective, good or bad, SPACs.
We're just starting to look at them. An unbelievable amount of money has gone in there.
Incredible.
I think the jury is still out. Someone said to me he had a fund where, you could put money into it and basically have a free look for 2 years. And if you didn't like anything, you just get your money back. Okay. Well, let's assume that's the case. The problem is that if I end up getting my money back in 2 years because I didn't like any of the deals they were about to buy, then that's 2 years I didn't have my money in biotech. So if it's going to be, for example, 2 good years for biotech, there's a very significant cost to having your money in SPACs and deciding not to do any of the deals that they show you. So as with everything, I'm sure there are going to be some very interesting SPACs where people are going to make a lot of money. I'm hearing more about it, but we haven't taken a very careful study of it. And so I would say that that's still a work in process. And we think about that.
I know you have some money in lending funds that obviously could be challenged during COVID for a variety of reasons. And potentially that's kind of the counterparty risk. What percentage of the portfolio is in lending funds?
It would be under 10%. And the lending funds have particular characteristics. In almost all cases, with one exception, 2 exceptions, out of the 10, 11 lending funds, there are 2 exceptions, what I'm going to tell you. They're basically real estate loans. They're basically very short term. They're run by people that are basically running small little lending businesses, substituting for banks in certain communities. They are almost all first mortgages. In almost all cases, there's zero or very, very minimal leverage that's being used. And so that tends to be what the overwhelming percentage of our lending funds look like. We've looked at some corporate lending funds. We're not really comfortable there for a couple of reasons. Number one, some of them use a lot of leverage. Number two, some of them charge on not just your capital, but your allocable portion of debt that the fund assumes. So if they borrow $2 for every dollar of equity and they charge you a 1.5% fee, you're basically paying 1.5 on, $4.5, as opposed to just the $1.5 that, is your equity. Remember, the example would be if you put up $1, I'll do it differently. You put up $1 and for every dollar they borrow 2. Okay. So your share of the portfolio is $3. It's $1 of equity and it's $2 of the allocable leverage to you. In some cases, the managers are charging their management fee on the $3. We just, that to us is a non-starter. We're also more concerned on the corporate side because the valuations, can be a little bit more magical, if you will. Okay. It's pretty easy to understand what the value of real estate is, especially if you're lending to properties in cities where someone is converting a property to, let's say, 20 condos. Okay. And if you're in a city, very often, every week there's a couple of sales of condos of the exact amount of square footage. So it's reasonably easy to get pretty good comfort as to what your collateral is worth in most real estate markets. We're not as comfortable with that analysis in corporate. So maybe other people are smarter than us and better than us, and they've done very well in corporate. I know some have, but we just tend to stay on the real estate side with the first mortgage position.
And, we're covering a lot of different asset classes, and none of them, we could do any one of them and do a full hour on it. So yes, I do understand we're going a little bit very, very high level. Back a little bit to VC. I definitely have some families. You apparently feel differently, and I want to know your thesis why, that we potentially could have a biotech bubble.
Well, right now in VC, and then we'll get to biotech, in VC, our managers think that prices are pretty rich. And so they would definitely say in non-biotech VC that whether they would call it a bubble or not, I don't know, but they would say we're definitely not on the very, very cheap end of the spectrum. The issue is some of these younger companies are growing so quickly that and interest rates are so low that it's easy to understand why people are plowing into some of those companies. And we'll see down the road whether they're right or not. In biotech, some of the managers, none of them have used the word bubble, but they have said that in some cases, they think some of these companies are at rich prices. If you go to the earlier stage biotech companies, and you get a company that starts seeing some very interesting activity in some of their compounds, there's so much upside in some of those younger companies. I mean, to become a $1 billion value biotech company is not the hardest thing in the world today if you have some very promising results from your science. So if you can get with the right managers in biotech that are doing the earlier stage investing valuation timeframes, there's a lot of room to grow. Yes, are biotech managers telling us that they think a bunch of deals are overpriced? That's correct. But that'll sort itself out. The reality is in biotech, you're either going to be with the managers that have been very, very good at seeing which companies really can make a big difference and which can't.
And you mentioned you have a lot of allocations to different managers broadly in VC. What percentage of the allocation of your portfolio does that make up?
Under 10.
Maybe like 7 or 8?
Yeah, that's about right.
And I'm assuming you look at that as being, there will be some level of asymmetric type returns. Some will probably underperform, but you hope those that overperform, that's going to provide some of the alpha that you're potentially looking for in your portfolio. And deep tech, from AI to virtual reality, robotics, has certainly been very hot. It's a very challenging market, but yes, it could potentially do very, very well. Let me ask you about something. I don't want to assume the answer is no, so I'm just going to ask you, do you invest in cannabis?
No.
And nothing you have an interest in looking at?
We know people who do. One of the funds we invested in, the private equity fund, the manager invested in a small cannabis company. But, we're so busy trying to make sure we keep understanding the 8 buckets we're in that we just haven't found ourselves there. We don't understand it that well. If one of our top managers ended up investing in some cannabis and it was his judgment or her judgment, we'd be okay with it. But we're not really seeking that out. When we look at the portfolio, we have return expectations for each of the 8 buckets. Okay. The return expectation for cash is whatever it's paying today. The return expectation for equities is about 10. And we got that number because that's a long-term historic number. So we don't think that with equities, especially here, we can make 15 or 20% per year for the next 10 years. We're just assuming the long-term return and we'll see what happens. For hedge funds, we're assuming a couple points more than 10 with a lot less volatility. For the real estate direct investments, we're assuming low to mid-teens over time. If we owned an apartment building for 8 or 10 years, a combination of cash flow and appreciation and potential refinance. For the real estate funds, we're assuming mid-teens. These are all net numbers because that's what you should get if you're going to tie your money up in private equity. For the private equity distressed, which are usually 2 to 3 years in and 2 to 3 years out, we knock a point or two off the 15. For the lending, we're assuming, between 10 and 11, let's say between 9 and 11. We don't think that's very, very difficult. We don't think that's tough to do. And for the venture, we're assuming 20 plus. And that's,
that's your, that's where you're really looking for your alpha.
Yes. And we've been very fortunate in a couple of cases. I said, I hope it isn't, beginner's luck or everything, but that's where we think both on the venture and on the early stage biotech, we can hopefully see ourselves making, an investment of a couple of $100,000 that could be easily worth a couple of $1 million 4 to 5 years later. So that's where we look to do those types of returns. We're not going to get them in the hedge funds. We're not going to get them in equities, but we can see that in the VC, which is in addition to the biotech portfolio. I'm including the biotech portfolio inside the hedge fund portfolio. And when I talk about VC, I'm talking about the non-biotech VC.
I have a question. I kind of hinted at parts of it earlier where it's going to be out of left field, Marty, but I think it's important. What I mentioned earlier about potentially inflation, about what could be very high taxes here in the US, we'll see how that plays out. And the fact that you're active in biotech, and I'm pretty connected in that community. I know a lot of thought leaders. Some of them have appeared on the podcast. They all tell me with genomics, and I believe it's called Wright's Law, that like Angelo, we're not quite there yet, but in the next 5 or 10 years, there's going to be amazing advancements that we're going to live longer. And from what they tell me, somewhere between 100 and 130. And some of them say that Wright's Law of genomics, look it up. I don't want to make it sound like I'm a little too out there out of space. We might even live longer than that. And that's what I said earlier, relative to how we're investing, arguably, if it's too conservative in a world that's turning upside down, that has black swans and all that, and families are withdrawing 5, 6, 7, 8% a year. I notice it's hard to believe they may not make it. If I got people that are in their 70s saying, I don't know, I got 10 years left. Maybe not. You might be right. You might have 30 to 50 years left. And are you really prepared for that? Do you, with your activity in venture capital and biotech and the people that you know, do you actually hear some of this and that plays into your decisions in your portfolio?
Well, I don't want to get in trouble here, but a couple of things came into my head when you talked about living till 120, 130. Okay. The first thing that came into my head was, yes, there are advances in biotech, and there's no reason to think that given, a century or two ago when the average life expectancy could be in the 40s and now it's in the 80s, that it might not significantly expand.
And that's a double. It's not just 40 years, it's doubling.
Yes. The other thing that occurred to me, Angelo, to be perfectly honest with you and completely transparent into, what I thought about at the time was, if people can live till 120 or 130, as opposed to just living until their 40s, the meaning of until death do us part takes a much more significance to it. If people are going to be celebrating their 80th and 100th anniversaries as opposed to their 50th anniversary, then we're going to be in a different world in so many different ways. If my wife knew that I could live till 150, she'd probably drop dead over that, the fear of that. Okay, but I'm just saying it's going to be a different world in so many ways if the average life expectancy of people, Angelo, is 100 to 150.
That subject, you remind me, actually came up with Larry David in an episode from probably 10 years ago in Curb Your Enthusiasm with his then wife, Cheryl, on the show. I think Larry David's the best, by the way. So that's now everyone knows what I watch.
I hope you'll still invite me back after that observation.
Let's get to real estate. You covered it to a degree with direct investing, fund investing, multifamily housing, not looking to hit it out of the park, being conservative, and the value of owning a real asset, potentially inflation or deflation. And even issues with the dollar, that likely they're not making more of it. It likely is a safe bet. But I'm going to jump ahead a little bit. You told me a couple of days ago that you potentially are looking at what I'm going to call something somewhat asymmetrical. So I told you that I went to New York for the first time in a long time, and I did some write-ups in my social media, and some things were negative and some were not as bad as I thought and showed some promise. But Midtown, oh my God, it's a ghost town. Hotels like the Grand Hyatt and the Roosevelt, classics, are gone. Effectively, owners over-levered, turning in their keys. Now, you mentioned, yeah, that creates distressed opportunity, and that creates the opportunity for when things come roaring back. And even if it's not 6 months, maybe it is 2022, but we're not looking at this in 6 or 12 months. We're looking at it more long-term. Peter Schiff, who I've had on several times, would probably say, okay, let them go bankrupt. New ownership takes over. The hotels are not going to magically float out into space. They're still there. So you're looking at this as being potentially, not without some risk, but potentially what I would define as an asymmetrical opportunity that could do very, very well.
There's no doubt about that. And so this isn't so much an inflation or deflation play, it's a COVID play.
Yes.
It's a COVID play. It's a distressed COVID play where you're buying businesses at historically unbelievably cheap prices, but not cheap multiples today. You have a completely, I don't want to say artificial, but you have a temporary massive decrease in revenue due to COVID. That is going to reverse. Okay. And there's very little doubt in my mind that there are going to be people who are going to be able to buy great assets in many cities, not just New York, which have been extremely negatively affected because of COVID, that are going to recover. I suspect hotels might recover quicker than office, but it's a very difficult call there because so many aspects of, you're probably the first person that, anybody since March has seen wearing a tie. I haven't worn a tie, no less a shirt, so that people aren't going to the offices. Okay.
I didn't wear it in my 14-hour day in New York City a couple of Fridays ago.
Whatever. But the point is, yes, and what's also happened for the last many months is that people that were in trouble with properties were being given forbearance by the banks. That period is coming to an end. And so there are going to be people who are going to turn in the keys, and there are going to be banks that are not going to want to own or manage these things, and they're just going to sell them to people who are going to make fortunes, even if it's not until 2023 or 2024. So it's absolutely true that in my view, that there have been an incredible number of cases where great distressed bargains are going to exist by virtue of businesses being destroyed but not eliminated due to COVID.
From what I hear from my most significant families and my ear to the grindstone around the world, they're 99% on board with you, which I am as well. Real estate could still be a very intriguing asset class. We're probably a little early from the best deals coming to the market that may happen more in the spring or a little bit later in 2021. I'd be very concerned about office and retail, but we'll save that one for a little bit of a different day. But in terms of hotels or maybe repurposing to a degree, a lot of people were over-levered, and that's something that you're always careful about, not being yourself. And real estate could be an amazing investment. It has tremendous tax benefits. Look at Donald Trump's tax returns. But when you're over-levered and that price drops and they come knocking, then you got a problem.
Look, there are two critical elections coming up. The first election, as we said, on the national level, is in Georgia for the reasons we discussed. Okay. The second election that is extremely critical for at least a particular city, like New York, is who is the next mayor going to be. Okay. If you have another mayor that comes in with the mindset of the current mayor, that's a problem. If you have another person who, I believe there's a gentleman from Citibank running, if you get a mayor that understands that New York is a serious business as opposed to a social experiment or a platform on which to virtue signal, there I am being partisan, then it'll be very difficult. The other issue with New York is the politics, and it doesn't just come from the mayor. There are people we know that are in the hotel space that said they'll go anywhere, anytime, but they will not go to New York because they don't want to fight with the unions. We have people that have been in multifamily forever, including in New York, multifamily. They say they will not do any new projects in New York because they just don't trust the politics of it. We will see how that will get worse or get a lot better over the next couple of years after there is a new mayor, and how things go. But I am definitely hearing those comments from people that have been in New York real estate for a very, very long time.
And on real estate, let me ask you about two other sectors in real estate that I think could be wonderful opportunities. I would say some industrial real estate, imagine e-commerce fulfillment centers, and data centers. What do you think?
No question that industrial has been good. Don't know that much about data centers, but it sure seems like, something that makes a lot of sense. So look, we know there's solid parts of real estate. The multifamily in general has been very, very solid. Even though Manhattan rents are down by 25%, but that's kind of unique to Manhattan. Traditional multifamily around the country is held in very, 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 very well. No question, hotels are currently much more stressed, but I think we'll be less stressed in office going forward because I think people will come back to New York for Broadway and everything else when tourism comes back much quicker than people will fill up office buildings again, but that's just my gut on that. Retail is clearly under pressure, will stay that way. Industrial definitely has done well. People have done very well in industrial, and from what we're hearing, it's still a very, very strong place to be. And the type of data centers that you refer to could definitely be an interesting place to look at.
Yeah, I won't bore people with some of the macro numbers behind it. Maybe Raul will cover it tomorrow. But there's going to be a tremendous trend to manufacturing and other services coming back to the U.S. And part of that plays into the dollar, emerging markets. There's a variety of complex macro factors in that. By the way, to be a really good investor, we hinted at it earlier, you don't need to be an economist. You don't need to be a macro expert. Actually, too much knowledge may even freeze you. You could argue. When you want to outsource smart people like that to get their opinion, that's great to be part of an investment committee. But really, tremendous investors outside of people in, the black box stuff and the magic that they do. Actually, that's a good question. Do you invest in those kind of managers, even if it's 1%?
The answer is that we don't, but we could all think of one that starts with an R.
We would all like to be into that one.
And the answer is no, but I could imagine a situation where, based upon the manager, we wouldn't consider it, sacrilegious to put some money in something like that. So the answer is, quite possibly yes, but in general, no.
That's kind of what I like about you for someone who's been an investor for so long. And we're going to get to another one that you probably have said no to, but you're not totally close to it. We'll get to that in a second. Private companies, you're getting exposure through private equity. You're leaning towards distressed. You're looking for something a little bit more of a quicker turnaround, even if it's not going to be maybe as potential alpha long-term. Do you tend to focus what's been hot with some of our families, unless they're just too big, the families have been smaller private equity shops, but you may have more of a focus in the distressed than some of the big ones that we all know. What are you doing?
Well, if there's one piece of the allocation we've cut back on, it's the traditional private equity. Okay. We've been with some very good funds that had average results. So we really think that you're just not getting paid for the risk and the illiquidity you're taking unless you can net 15% in private equity. And the funds that we've been in, more of them did not do it than did do it. Okay. When we do to the shorter term, 2 or 3 years in for distressed private equity and another year or two out, those have come closer to doing that. And so far, the VC funds we're in are very substantially in excess of the 20% return that we're looking for. So that's one place that our success has been below the target return, which was in PE. It's right in the zone for lending. It's pretty close to the zone for the hedge funds over long time frames. It's pretty close to the zone for the real estate funds, especially for the real estate direct. But the traditional PE was one area where we were somewhat disappointed with the returns. Nobody, killed us, but we just made it less than what we thought we should have given the lockup.
We have a big project that we're doing, and you're a personal member. You probably haven't done it yet, but it's a research project where we ask 37 pretty deep questions. None of them are multiple choice. So unfortunately or fortunately, they do require probably an hour to an hour and a half to fill it out with a level of detail. But we're getting some of my questions were around during the upside down markets during COVID. What are some asymmetric opportunities that you've looked at and how have they played out? And by the way, although they probably don't want to admit it, tell us what hasn't worked or hasn't worked yet, but maybe it's the timing. So, you mentioned maybe a pinch early now, but soon to pounce on some opportunities with hotels. I absolutely agree. I think that's going to be one if you get it at the right price. Broadly, being in venture gives you some degree of that because you have a fair number of managers. We're going to get to one a little bit later called Bitcoin. So we'll put that one to the side for now. But to me, that would definitely be something that would be asymmetrical. But there is one or two that kept on popping up. One, we mentioned SPACs, and even more so being a SPAC sponsor, which could be an interesting and tremendous business. Now, we got one that I'm going to put in the bucket of VC and biotech. It's going to make you cringe. And no, it's not cannabis. We already discussed that. Tremendous opportunities from some families I'm seeing in psychedelics in the public markets. As that whole dynamic is changing for medical purposes, we're seeing some people investing in the public markets where they're getting outrageous returns. They're putting tiny amounts of money to work. But besides that, which I don't assume, although maybe indirectly through some of your, ventures, so you don't know, you may have to look into that in a good way. What else are you maybe looking at that could be where if I put in a small amount, maybe the worst thing is I lose it all, but it's under 1%, but I have a chance to get 5, 10, or even 15 times X in 3 to 5 years?
Sure. One thing we're doing is some European trade claims.
Yeah, that would be one.
Claims. That isn't all that risky because, first of all, we're not buying any claim where there's been a final judgment as to liability. It's simply damage proving. The places where we have been putting small amounts of money, 10, 20, 30 basis points, sometimes more, is in sidecars with our venture funds. And so we look at, if we don't think we can make, 3 to 5 or 10 times our money in a given sidecar opportunity, we don't do it. And so we have been very fortunate recently to have some sidecar one-offs that look like they're going to give us what our target is there. So that's one place, and they're very, very. It's not because we found an asset class that is so unique. It's just because the managers in VC that we're working with are very, very talented, and they're coming up with some very, very interesting ideas where we're getting in at very early stages. And if those ideas turn out to be right, then the returns are massively outsized. And because almost all of the companies we invest in have revenue, there really isn't much risk of the product not selling. That's a little bit different in certain types of early stage biotech where you're waiting for some scientific results, but in those cases we have a very, very diverse portfolio of, probably through our managers, a couple of dozen, smaller companies where we're waiting for scientific results to come in. And so that's where we look for the gigantic outsized returns. Where we've lagged, and I don't want to say disappointed, but where we've lagged for the last couple of years is in some of the hedge funds, which are credit oriented, where the distress cycle was much longer, it took longer to get here, where interest rates stayed low. So historically speaking, the results from some of our credit hedge funds were lower than they would have been over long historical timeframes. But you know what? We're okay with that, because the whole purpose of this portfolio is never to have to get rich a second time or to recreate the wealth a second time. Okay. And it's not a race, it's a marathon. We know that we're not going to have a gigantic home run in any one year as a portfolio, because our lending funds are not going to give us a home run. Our apartments aren't going to give us a home run. The cash is going to be a drag on returns. So if we can figure out how, with a very diversified portfolio of, getting consistently, low double-digit rates of return, that's fine, because the spending off the portfolio is nowhere near what it generates. And so this is all about never having a significant portfolio loss at the portfolio level.
Yeah, I mean,
your
diversity and experiences in managing that process is certainly, it's renowned. It's been great. Do you have any allocation, whether personally or through Sandalwood, in gold?
No. And the reason we haven't is because, well, I mean, some of our hedge funds might have some, but on a look-through basis, it's not going to be material. I know people that say, well, we always have to have 1 or 2% in gold. 1 or 2% in gold isn't going to mean anything. I mean, if gold doubles, so you got 4%. And so we've never really thought that the hedge that people think it will provide for them can be that material to the portfolio, unless you're going to have more than 1 or 2% in it. So generally speaking, we have not been gold buyers.
That's actually a pretty astute thesis, and that is true. I may disagree with it, and I personally would recommend a higher allocation among families. Yeah. I won't bore the families with probably an ETF is not a good choice, why you should directly own it. We did an interview with Simon Mikhailovich. You can look it up on my YouTube platform, and it was very long, and he's very deep. If you talk about gold, Marty, I have to bring up, I know the answer, but let's talk a little bit about it. Any allocation to Bitcoin?
No, but let me just go back to the gold thing for just 1 second.
Sure.
And that is that if gold is going to go up a lot, it's probably because there's inflation, right? Right?
You can make, let's say yes.
Yeah, okay. I mean, there's a good chance.
And like you said, what do you mean a lot? It doubles.
I agree. I agree. But if gold doubles, there was probably inflation as opposed to deflation, right?
And we have problems and other issues, the dollar,
yes.
And all that.
Yes, but we live in a dollar country, and if there's a lot of inflation, we own a lot of apartments, we own a lot of real estate.
Yes.
So we're going to capture the benefit of being in an inflationary environment through an asset class that generates sheltered cash flow, just as we would benefit from an atmosphere that generates an increase in gold prices because of inflation, but yet gold doesn't generate cash flow. So that's another reason that we think we're going to be okay in an inflationary environment. Now, getting to Bitcoin, we don't own any Bitcoin yet. I know some very, very smart people that started buying Bitcoin a while ago, and they think that in a couple of years, Bitcoin could be at, it's in the 18,000, 100,000. They think it's a 5-bagger from here or more. Okay. I know other very, very smart people, and everybody here's heard of them, that wouldn't touch it. And they simply can't get their arms around, what am I buying? If you buy gold and it doesn't work out, you can always make it into earrings and give it away. Okay. But I still, and this is more of a testament to my ignorance than to my analytical capabilities. Am I buying something that can process payments, which has a value, and therefore Bitcoin is the medium to allow me to buy a payment processing business? Am I buying a mineral, a commodity? I just, the answer is, I don't know. The other confession is I haven't spent a lot of time looking at it. And so I also have a hard time, putting a lot of net worth in something that might disappear if I lose my password.
You know, Marty, that was one of the best answers for someone who is not allocating at the moment in Bitcoin. And it's very intellectually honest. People on both sides of the camp. you know just enough about it to be familiar with it. But no, you've not put in even 10, 20, 30 hours of deeper research into it, but you're aware of it. And, maybe you keep an open mind, which is unfortunately what most people who have been successful investors for even a decade, let alone 40 years, don't do. That is basically what I'm seeing from my families. I would say probably 3 to 5% of them would have, whatever, something more than 10,000. It's tiny. There's a couple that have more. I've done significant research on it. I have an incredibly comprehensive white paper for my members coming out next week. And Raoul Paul and Lynn Alden, two incredible macro strategists, coming up on Thursday. And Lynn Alden, look her up, amazing, coming up on Monday of next week. And then I'm interviewing a private investor, JJ Sowers, next Thursday. I think the future, when you really do the analytics of it, Bitcoin, Ethereum, blockchain, stable coins, and DeFi, you should have some exposure in your venture. Talk about exponential and astronomical. First of all, I think you could possibly lose it all. So the best advice is 1 to 3%. You lose it, your world doesn't end. But talk about an asymmetrical return. This is not doubling or going up 3 times. Either it goes completely near to zero and you accept that because that's the risk you took, or you crush it. And now is going to be the time. Let's not go into Tudor Jones, Drunken Miller, PayPal, and governments. That we'll talk more about with Raoul Paul tomorrow. That's 4 p.m. tomorrow. For those watching this on video, by that time, you'll probably be able to see it in my private platforms or request it, and I'll send it to you. I did have a couple of families talk about, not in any kind of fund or investment structure, but they did find value or maybe personal satisfaction investing in collectibles, in art, in watches. And by the way, the most common one that came up was FP Journe and wine. Do you personally invest in that, or it's only for just personal enjoyment?
Well, if I invested in wine, first I would put that in the liquid asset bucket.
And one that you would probably drink.
Maybe. I actually do have collectibles. I do have some rare books and things like that, but I don't buy them as an investment. One of my friends in the business said he could never become an art collector other than out of the love of collecting art as opposed to the business of collecting art, because the bid-ask spread was just too ridiculous. So I think that, I wouldn't take off the table investing in collectibles, especially if it's something people really enjoy. I know that if you're going to collect something like books, they're going to tell you that you got to wait, 10 years to start seeing some significant appreciation because of how you have to start paying for that. I can tell you that being a book collector, and I look at the catalogs of books for sale, I can tell you that some bookshops will try to sell something worth $50,000 for $100,000 just to see if anybody bites. So you just have to, if you're going to be in collectibles, you really have to be knowledgeable about it. I would just
for sure. And I mean, Marty, this was a pretty, a broad conversation from a investing perspective. We didn't get too much into, and I want to give you the floor for 2 minutes to wrap up. Families are going to listen to this and say, my God, what a great investor Marty is. He also, again, is the founder of Sandalwood, a very successful investment or alternative investments organization. For families that don't want to do all that you're doing, from diligence in choosing managers to sidecars and VC to direct investments, and are like, wow, maybe tell me more about your organization, Sandalwood, and maybe how qualified investors can maybe learn a little bit more.
Sure. Well, first of all, me being a great investor are your words, not mine. And the only reason I say that is because, the more you do, the more you realize that, there are things you wish you knew that you didn't, or that you don't and you can't. So we try to be as simple as possible in a lot of our investment decisions, which is why, for example, focusing on multifamily apartments is something that doesn't have as many moving parts as other kinds of things. So we're about 10 people. We have about 300 clients. When we do investments in these different areas, we know our clients, we know what they like, we take them with us. So if we're going to be doing a new real estate fund, we know which clients want to do real estate funds, so we create a situation where they can invest with us. The only thing we show our clients are investments where we are investing our own dollars first. And, the most important thing to investing, in my view, is really a couple things. The first is you got to make sure you look down before you look up, okay, in terms of risk. And the second thing is, you have to come to the office every day thinking, knowing that there's a bunch of stuff you don't know, and you try to learn as much as you can. So if you don't walk to the office every day, kind of focusing on what you don't know that you'd like to know as to what you think you're sure of, you'll very often find that what you were sure of wasn't the case. It's kind of like, Ronald Reagan once said that, it ain't what I think it's something like, it ain't what they don't know that bothers me or that scares me. It's what they know for sure that I know ain't so.
Yeah, it's a great saying.
Okay. So, we try to be very open-minded. It's like the Bitcoin thing. I'm not ruling out the possibility of putting, a very small allocation there in the event that in 10 years from today, it's a lot more. Even if I personally didn't understand it as well as I wanted to, that might be something where I wouldn't show to clients because I couldn't have the level of comfort, that I could, that I feel comfortable with in certain other asset classes. But, your point about 1% to 3%, I agree with that. I think that's right. The most you can lose, it's not clear to me you would go to zero. But I accept that as a very interesting allocation, and could definitely make sense. So, that's what we do. We've kind of evolved from our fund-to-fund business into a family office. We've gone over the allocation. We've told you and your audience, which was appreciate the time. It was really good, Angelo, to talk about areas we think are interesting. We are actively pursuing areas that we've spoken about. We are pursuing opportunities in funds that will play hotels on the post-COVID. We're continuing to do more VC. We're continuing to do more lending funds. We're very happy now with how the distressed credit funds are performing. We think we have a good couple years there. We're not so sure how our long equity portfolio is going to do. To a lot extent, that depends on Georgia and what may come from that election, but we're not going to change that allocation very much. We have a couple of long only managers we just leave the money with for very long time frames. So the world got a lot interesting after COVID. There is no doubt about the fact in our mind that there's some very interesting opportunities that have been created just by virtue of a subset of industries being so negatively affected. We're still getting up every day, having a good time, looking for good ideas. In many ways, it's, very intellectual activity. It's applying ideas to money. Where should I put the money based upon what idea? What's the investment thesis? The good news is that what's the Chinese expression? I curse you to live in interesting times. Well, I don't know whether we've been cursed. The COVID was surely a curse, but we are definitely living in interesting times from an investment perspective, whether it's the potential innovation in biotech, whether it's a huge number of younger people that are very talented going into VC as opposed to having to be in one of the top 5 funds to have a good chance of making returns, to all the different, things going on in real estate now and the whole area of, playing COVID coming back. There's a lot to do. There's a lot of interesting stuff. The world's got really, really interesting. We'll see how things go.
Yeah, let me make a couple of other comments. That was very humble of you in terms of how you describe yourself and your successes, and very open-minded, even though many decades of success, still saying there's things I don't know, things change, things adapt, and you have to adapt with the times. One of the benefits, I guess you could say, of membership in Family Office Association, I hope, is getting to know people like Marty. People that are fellow members, opportunities for peer-to-peer connectivity. It may not always lead to business, but it goes to sharing ideas. And now more than ever, how valuable is that? Marty, there may be some people that simply want to reach out. Perhaps from an investing perspective, is there a direct email you would like to give?
Sure. They could either, get it from you, or it's MJG, as in Martin Jeffrey Gross, MJG at sandalwoodsecurities.com, SANDAL Wood Securities, plural, one word.com. So that's
excellent. Marty, this has been amazing. I look forward to certainly having you back in the spring. That might be an interesting time to see what happened in Georgia, to see what's happening in New York, in the hotel opportunities that you're talking about, and see if maybe I talked you into a 50 basis points allocation of Bitcoin.
Yeah,
keep an eye for my white paper.
You might have talked me into that. I get it. Listen, you know, it's a split decision. There are some very, very smart people that I know that did it, and I have great respect for their thoughts.
It's probably inevitably going to be BlackRock. Once it gets approved to do an ETF, and so far it's been shot down, it's going to happen. And probably BlackRock is going to be the driving force behind it. Then it's going to make it incredibly easier than the issue with keys. And then you can even short it if you want. So what I would like to do is I'm going to give my close. I'm going to keep it about 1 minute. I'm then going to stop the video. And I would like to give people a little bit of a tip for tomorrow. Marty, if you have to run, don't worry. But those on the line, I promise I'll keep it maybe 60 to 90 seconds. I'll make it very quick. But let me do my close now while we're still recording. Well, everyone, I hope you really enjoyed Marty Gross. He's amazing. I have the pleasure of knowing him, being reintroduced from a mutual acquaintance, Laura Moore, who's wonderful. And it's, great to be, to have so much I learned, and I took notes from Marty. I'm Angelo Robles. I'm the host of the Angelo Robles Podcast, and probably more, or some of you know me more applicably as the founder and CEO at Family Office Association, a global membership organization dedicated to families of great wealth, great investors like Marty, and their single family offices. We do a tremendous amount of research, thought leadership, host global programming. I did do a workshop in Miami just a week ago, so technically, even during COVID, it may not have been the smartest thing in the world, but it was small and very carefully done. So we theoretically are active even physically, but I do hundreds of digital programs every year and a lot of other things that I won't bore anyone with the details with now. Go to our website, familyofficeassociation.com, and for free, probably subscribe to my YouTube channel where we have a lot of information, and simply that's Family Office. On that note, thank you so much, everyone. My live audience, if you could hang on just 90 more seconds, but we'll say goodbye from a video perspective. Thank you very, very much.